Greetings and welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA Edge and CEO at Trout, TPSU, and 401k TV. I review all of last week's stories and select the most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story, job growth in June cooled down with just 209,000 new jobs added versus a predicted 240,000 and 306,000 in May. It is the lowest number of new jobs created in 30 months of consecutive growth. Unemployment at 3.6% was down a tick. The growth was led by healthcare and education and government positions, with retail losing 11,000 jobs. Business services rose by 21,000 after recent downturns. Though the Great Resignation may be over as new job openings fell in June, the war for talent is not, with a renewed emphasis on retention. As I wrote in my column this week, the pandemic has fundamentally changed retirement plans due to the increased demand for high-end talent, transforming 401k plans from a tactical benefit like healthcare with the primary focus on cost to a strategic benefit, especially as more workers enter the gig economy. Next story, the Portability Services Network, led by Retirement Clearinghouse, added Principal to the fold, bringing the total number covered to 82 million workers. Principal joined Fidelity, Empower, Vanguard, TIA, and Alight, with more expected. The network, rather than collecting data, is creating a data exchange protocol, which will facilitate the easy transfer of plans from one provider to another, which could also enable retirement income solutions, account consolidation versus IRA rollovers, and access to data to facilitate wealth management services eventually. Meanwhile, Millennium Trust announced their own network, inviting providers to join with the hope to get critical mass rather than the one-at-a-time approach that the Portability Services Network has used, which has worked surprisingly well. Next story, after SageView poached Senior Vice President Jeremy Hawley from LPL in 2021 to lead their wealth advisor acquisition efforts, LPL announced that Hawley will be rejoining the independent broker-dealer at an elevated position as executive vice president focused on liquidity and succession planning. Many independents like LPL have been losing their top advisors to aggregators like SageView, which raise private equity money to buy advisory firms, and has been stepping up to invest and even acquire their advisors. Osaic and Cetera, which hired Fidelity's head of RIA services, Mike Durbin, as CEO, have also been actively retaining their advisors, adding more buyers to an already hot M&A market. Next story, while many universities tend to settle their 403B lawsuits because of the litigation costs, Yale decided to go to trial in a suit brought by Jerry Schlichter and recently won their case with legal costs at an estimated $15 million. The plaintiffs allege that Yale moved too slowly to reduce record-keeping fees, consolidate providers, and move from an asset base to a per participant cost. Will other plaintiffs start fighting back rather than settling? The industry is patiently waiting for the resolution of the FlexPath case, also brought by Jerry Schlichter, even as the firm recently separated from its NFP parent to avoid such conflicts. Next story, has the bloom fallen off the rose of PEPs? One consultant noted a slowdown in 2023 of new filings with the DOL, perhaps because of increased audit costs for smaller plans that would not have otherwise been required. The promise of cost reductions through PEPs has not been realized as expected. While larger plans are adapting PEPs led by investment consultants like Aon and aggregators like Lockton, which was not expected, smaller plans practically immune to lawsuits that plague bigger ones could become targets as part of a PEP. I'll be writing a column next week about PEPs with an announcement by a large insurance broker-dealer. Finally, are fintech record keepers a threat to traditional providers? That's the conclusion of a Cogent report, citing the demand for lower costs by plan sponsors, perhaps driven by surging litigation. Cogent notes that these fintechs offer better payroll integration, better digital interfaces, better participant onboarding, and has more sophisticated underlying technology. They are also more willing to share participant data than traditional record keepers, most of whom struggle with clunky technology built in the 1990s. Many of these fintechs have been partnering with firms that have distribution, like Bestwell and JP Morgan and Guideline and Gusto. Are there other industries with relationships to employers or distribution systems that will step up? Meanwhile, most traditional record keepers still struggle to service the expected exploding small market profitably, which is well suited for these fintechs. So those are the most important stories from the past week. I listed a few others I thought were worth reading. Please let me know if I missed anything or if you have any comments. Otherwise, I look forward to speaking with you next week on 401k Real Talk.